What is going on, guys? Winning 1324. Appreciate your donation to St. Jude. Miss Mars 007. What's going on? Surf. What's going on? Christian Gray. Adersh. Coop. What's going on, Coop? Hey, what's going on, Evan? Haven't talked to you in a bit, man.
Welcome back. About 10 minutes from the Fed decision, and here on the exchange, we've been following not just the rise in oil prices, but also the spike in fertilizer component urea in the past couple of weeks. The futures have soared 30%, and they're sitting near record highs. Bank of America writing in a new note today that the increases in both fuel and fertilizer could mean 20 to 30% upside in corn prices, 15 to 20% in wheat. That's the base case now. Let's bring in Peter Galbo, talk about what that means for the staples names he covers. He's senior consumer analyst, staples analyst at B of A. Peter, did you see the PPI this morning? I mean, we already had a 50% increase month on month in the price of fruits and vegetables. I have no idea if that's immigration related. That's just one theory. It's a big month on month move. With the same time, we have a strike at a meat packing plant. At the same time, you're telling me that corn and wheat prices could go up 20%.
All right, we're about 10 minutes away from the Fed decision. Fed is obviously going to keep rates unchanged, especially with the fact that PPI came in super hot this morning. One second. What the fuck? So PPI came in super hot this morning, 0.5% month over month on core versus 0.3%, 0.7% month over month, and then year over year, it's not listed here, but came in higher than expected as well. So there's that. There's the fact that, oil is surging, obviously because of what's going on in Iran and the Strait of Hormuz. And you have unemployment rising. So there's stagflationary risk. No way in hell is the Fed going to cut. So the Fed is going to keep rates unchanged. And it's, Powell, I think it's pretty much priced in, but Powell is on his way out. By May, he's gone. So does he have one more FOMC or is this his last one? Let me see. No, he has one more, April 29th. So April 29th will be his last one, and then he's gone. But if you take a look at it, even if you go out to December, which is the last FOMC of the year, it's still a higher likelihood that the Fed doesn't cut at all. So we're now pricing in no cuts for 2026, which is wild because there were 2 to 3 cuts on the docket initially. Now, I personally don't think that's realistic. What I think is going to happen is, Powell's not going to cut today. He's not going to cut April 29th. And then June 17th will probably be Kevin Warsh's new first FOMC meeting, and he might not cut in June depending on where we are with the geopolitical situation. Who knows? Trump could withdraw and the market rip and oil crash and everything's fine, and then by June we get a cut. But I don't think it's the case that Kevin Warsh has June, July, September, October, December. I don't think it's a case that we can go through 5 FOMC meetings under the new Fed chair who promised to cut rates. I don't think we can go 5 FOMCs without the new Fed chair cutting. I think we get 1 to 2 cuts this year, almost guaranteed, even though right now no cuts are priced in. They can't cut this year. Trust me, they will cut. Yes. But not Powell. Powell is not cutting. Like, Powell's going to retire without cutting this year. There's reverb, Brody. No, I think the sound is fine. The sound is perfectly fine. In terms of the market, we are just filling the regular trading hours gap from yesterday. Or sorry, if you look at the regular trading hours gap, this right here is between Friday and Monday. We haven't filled that yet. So I think we are going to fill that most likely today. What I think could happen here, based on if we take a look at the gamma, we have a lot of gamma concentrated at 66.50, and there's some at 66.15. But what could happen is, obviously for FOMC, there's going to be the 2 p.m. move, which is when the thing is announced. There's going to be the 2:30 p.m. move, which is when Powell starts talking. And then the volatility while he talks and answers questions. But there's going to be at least 2 moves, right? This is how we see it every time. So, and this is why FOMC is fairly easy to trade, because you get a 2 p.m. move and you'll get a high and low for that 2 p.m. candle. And then that high and low for that 2 p.m. candle is tradable, meaning if you're now above the 2 p.m. high, you will likely going to get a counter move to the 2 p.m. low and vice versa. So that's likely how I'm going to handle this. Gold might have an easier trade because we just took out that mid-February low in gold.
And welcome to Power Lunch. I'm Kelly Evans alongside Dom Chu this afternoon, who is in for Brian Sullivan, as we are just about 4 minutes away from the Federal Reserve's decision, its next move on interest rates. The odds of a rate cut are less than 1%. The market is basically expecting no action this meeting, but the path of future cuts will certainly be in focus. And it's Chair Powell's penultimate Dom press conference as head of the Fed. Ahead of it, here's how your money and markets are setting up. Scores on the doors, maybe they would call this. The Dow is down 442. The S&P is down 42. The Nasdaq's down 138, and the small caps are down 15. Bond yields, the last check was about 422 on the 10-year and 371, Dom, on the 2-year.
All right, of course, the big mover, Kelly, these days has to be in the oil markets right now. U.S. benchmark West Texas Intermediate WTI prices, you can see $96.52. It's up 1/3 of 1%, by the way, and that is way off the session highs at this point right now. World benchmark Brent crude went as high as $109.95, on pace for its highest settle since July of 2022. Both are up roughly 50% since the conflict in Iran began. So keep an eye on those oil prices. The U.S. dollar, by the way, up.
I think there could be a short in crude oil down to London low. This could be an interesting play here. 3 minutes away from the Fed decision. I hope this doesn't just tank, but I think there could be a short down to London low and eventually this volume imbalance down here. Paranoid AI, what's going on? They got UFC music playing? Yeah. What would it take for them to consider raising rates? What are you, psychotic? Nothing. Nothing. It would take nothing to raise rates besides if Jerome Powell wants a nuclear bomb dropped on his house. That's what it would take for Jerome to raise rates. If he wants his house firebombed along with Iranian targets, that's what it would take. If inflation catches, he has to raise? No, dude, he doesn't have to do shit. It's his penultimate FOMC meeting. He's not, there's no advantage for him or no incentive for him to do anything. And if you want to bet on it, I'll bet you $1 million. Legit. I will bet you literally $1 million. We'll put it in escrow that Powell's not going to do shit the next two Fed meetings.
Most important thing that the Fed has to watch for in your mind vis-a-vis all of those externalities being brought to bear?
Well, we're going to be watching the developments from geopolitical issues with the war going on. In their summary of economic projections, I'll be watching for whether they're going to upgrade their view on inflation, downgrade their view on the economy, given that fourth quarter GDP came in sub 1%, and what are their views on the employment market. Now, the bulls and the dovish members on the Fed are going to say inflation's here today, but slower economic growth is here tomorrow. We could still get 1 or 2 rate cuts into the books later this year. Markets are currently predicting only 86% chance of 1 rate cut in December 2026. Yeah. Of course, the hawks on the Fed are going to say that inflation is now here and it's chronic and we can't cut rates or maybe even raise rates sometime this year.
I don't know if we can show this in the next 5 seconds. Kalshi's odds for the next Fed hike, 60% before 2028, 37 before 27. Steve Leisman has the decision. Hi, Steve.
Unchanged. Federal Reserve leaving interest rates unchanged at a range of 3.5 to 3.75. It was an 11-1 vote with Fed Governor Steve Myron again dissenting, preferring to cut rates by 1/4 point. The Fed saying very up high in its statement today that the implications of developments in the Middle East for the U.S. economy are uncertain. But other than that, pretty robust or actually positive economic outlook. It continues to say, as it did last time, that the economy or the economic activity is moving at a solid pace. Say job gains have been low, but the unemployment rate is little changed. Now, as for the outlook, still 1 cut built in this year for the median Fed official, bringing the rates down to 3.4, and 1 cut for next year, another additional cut for next year at 3.1%. The long run, something that's been ticking up over time. The long-run neutral rate is now, see, at 3.1. That is up 1/10. On inflation, the median Fed official now looking for 2.7 on headline inflation. That's from 2.4 in the December forecast. Going back down to 2.2% in 2027. On core, looking for 2.7, up from 2.5, so 0.2 added there. Interestingly, GDP actually taking a tick up to 2.4 from 2.3 and 2.3 from 2% in 2027. So not seeing much of a GDP hit from the higher inflation forecast that is now part of the outlook. As for the dots, 7 officials want to hold, 12 want to cut. At least 1 cut or more. 5 of those want 2 cuts or more. The old range, guys, was a funds rate from, if you take all 19, the bottom was 2.1, the top was 3.9. It's come in a little tighter. Now it's 2.6 to 3.6. So a little bit of give on the dovish side, a little bit of give on the hawkish side, and now you have a little bit more centered around this 2.6 to 3.6 area. But again, the Federal Reserve emphasizing uncertainty. Interestingly, I would point out the idea that they upped their inflation forecast, but also they upped their GDP forecast. So that's kind of telling you perhaps where the center of the board is on the ultimate impact of the oil price shock. Guys?
All right, Steve, stick around here, please, because we have markets that are relatively stable right now, maybe not unexpected. We're all waiting for the press conference. Let's get out to Chicago for the reaction in the bond markets right now. Rick Santelli has that story. Rick.
Yes, Dom. If we look at all the intraday moves, twos, tens, and dollar index, what jumps out at me right off the bat is that the fixed income markets, twos, tens, the whole curve, we started to see yields drop even before anything was read at straight up 2 o'clock Eastern. So investors were buying treasuries in front of the statement, and after the statement, it had just a minor follow through. We were at 370 in a 2-year before anything was read. We're at 269 now. We're at 421 in a 10-year, exactly the same. So you're correct. Not a lot of movement in the markets. But let's put a face on this. If we look at where we've been, on the 12th of this month, we saw 2-year yields at 3.74. The high yield close going back to August of 25. And if you looked at 10s on the 13th, they had 428. A high yield close for the move post-conflict, but they couldn't even take out their 429 high yield close earlier in the year in January. So really what we're seeing here is the 2-year yields seem most sensitive to the notion that we're not going to potentially get any more rate cuts, but that didn't change today. That's been the way it's been moving, flattening the yield curve, which, by the way, hasn't really moved much in the last couple of hours. And ultimately, the dollar index, well, the dollar index is up on the day. It was up on the day. It gave up a few ticks, but hardly at all. We've had a couple of bouts over 100, which is very unusual. We hit 100.36 on the 13th. That was a high watermark all the way to May of 25. So to summarize, listen, the conflict is an awful thing from a humanity standpoint. From the market standpoint, especially treasuries, it's been mostly well-behaved, obviously higher interest rates, but maybe the poster child for how it's dealt with this is that the 10-year couldn't even get a higher yield close than pre-conflict. And, of course, the dollar index, I'm not sure it's a flight to safety. I think it's more a function of the ECB. We're talking about our central bank. ECB tomorrow, most likely they're going to be looking at aggressive tightening because the energy situation outside of the U.S., whether Europe or Asia, is changing all the dynamics on potential inflation and central bank activity. Back to you.
Thank you, Rick. Just want to turn to the panel here, David, for some.
All right, my bad. So the Fed leaves the rates unchanged. No surprise there. And you heard Rick Santelli there talk about the yields, and saying that, the bond yields don't seem to signal, if you're looking just at the bond yields, don't seem to signal any freakouts. Because he said that we couldn't even get a close on the 10-year that's above pre-conflict. I don't know what the fuck he's talking about, because when did this latest conflict started February 28th. So this right here was right before the conflict, February 27th. I don't know what the fuck he's talking about. The 10-year yield moved from a close of 396 to a close a couple days ago of 429 due to smoking crack. Maybe he means that we couldn't get, that on March 13th, it did not close above, say, early February. But certainly since the conflict started, the 10-year yield has only rocketed up. Whatever. How would you grade in difficulty year to date? It's been a pretty good year, to be honest. I had my best week this year a couple weeks ago. Did follow that up with my worst week this year. But if I'm looking at 2.5 months so far, It's actually been really good. Amazon looks cool, looks good here for a swing. Wait, so did they announce a rate or at 2:30? How do people not know how to fucking use Google? Like, if you didn't catch what CNBC said and you didn't catch what I said after that, just go on Google. I still think that crude oil. What time is the Fed conference? There needs to be a minimum IQ to participate in the stock market. Like there has to be like an IQ of, it doesn't have to be that high. Like an IQ of 75 minimum is required. Honestly. I think 75 would rule out a lot of people. The inherent laziness of people is shocking to me. Me too, bro. Shit. That's what's shocking to me. It's not like, obviously no one's ever going to know everything about the stock market, but just this lack of curiosity boggles the mind. Being too intelligent can actually work against you as a trader. This is actually true. Especially if you're used to figuring things out. A lot of times the market is going to penalize you for thinking that you can brute force figure it out right then and there. You can't. It's not like a puzzle where you're given, it's just a product of how much time you put in, right? Like Murphy's Law. It's not that kind of puzzle. If you're getting frustrated that you can't figure it out and then you try to take decisions when those decisions are suboptimal, you're going to get penalized for it. A lot of times figuring the market out is just doing nothing. So I think we start taking all of these gammas here. And Jerome Powell talks in 19 minutes. I do think there's a short in oil. I'm a software engineer and I struggle to figure it out. Yeah, the market is not an intelligence problem, bro. It's a behavioral problem. Look, I said this before, right? If I wanted to teach you how to do technical analysis and spot setups, right? Like say that I have a specific entry model. Right? Say that I have a specific entry model and I want to teach it to you. And I say, if you see this and this and this is the entry, and then you go long or you go short. If we were just looking at the market in that way, how long do you think that will take you to learn? A month? If that? Right? If I any entry model, let's just take a simple one, right? Like trend lines. And I said, when this crosses your trend line, then you want to go long. Okay. That's going to take you a month to be able to, maybe even less, to learn and identify. When people say that it took them 2-3 years to get profitable, it's not because of the charts. It has to do with your behavior, right? So when you enter a trade, are you able to sit through the red comfortably for a long time until it starts working in your favor, assuming your stop limit hasn't been hit? If your trade starts turning green and now you're up $3,000, but your take profit is up here, are you immediately taking profits because you can't stand the idea of losing that green, right? Because if you habitually let your stop limit get hit or move your stop limit, even worse, right? And you're taking a full loss every time you take a loss, but you only take a partial win every time you take a win, your overall stats are going to show that you're unprofitable. That right there is a behavioral problem. That's not an intelligence problem. If, for instance, you see something on the chart and you missed your entry and you're like, fuck, I wish I got in. And then you jump in late. So now during the drawdown is a lot more than you thought it was. And so then you cut it and then it ends up working in your favor. And so then you chase again and then it draws down. And so you cut it. Like, this type of shit is not intelligent. This is all behavioral. Please show Jex on QQQ. No. Yeah, it's psychology, but it's also behavioral, meaning it can be fixed with instilling the right behavior changes to counteract your natural psychology. But you have to be exposed to it over and over and over again. That's why people say it took me 3 years to be profitable, right? It's because it it takes that long to change something that is natural. Arthas, thank you for your donation to St. Jude. Appreciate it, man. We have Jerome Powell in 14 minutes. So far, not seeing an A+ trade here, and we still have the RTH gap below, which makes me wonder whether we want to take it or not. Mendeep, stop worrying about another man's money, dude. Worry about your own money. Worry about your own money, dude. Your dad should have already taught you that. So I'm going to reiterate it for you. Markets choppy whipsaw today. No shit. What do you think is happening today? FOMC. LA weather's so nice right now. Yeah, dude. We actually have had a heat. I just got back a couple days ago. And got back to a heat wave. Anonymous and Anonymous. Appreciate both of your donations to St. Jude's. Thank you guys. I want to see at least one of the indices take out today's low while the other leaves it behind. And then there may be a long on the horizon. Is some of your education focused on the psychology of chart patterns? What's the psychology of chart patterns? Bro, you're just combining concepts now. What is the psychology of chart patterns? You're either focused on chart patterns or you're focused on psychology. What are your predictions on MU earnings? I don't give a fuck. Anonymous donated $50 to St. Jude's. Thank you. Bro thinks the candles have feelings. That's what it sounds like. Okay, guys. So then he reiterates it. Instead of him saying the psychology of chart patterns, the follow question is, do you go into the chart patterns of psychology? This dude's trying to drive me crazy. What? Nick Knack, appreciate your donation to St. Jude's. Thank you so much. That was my joke? Oh. Funny. Definitely got me. Yeah, I don't care about MU earnings. I mean, who cares? Like trying to predict earnings, why don't you're just gambling, dude. I don't give a fuck about earnings. A company can beat earnings and rally. It can miss earnings. Can beat earnings and rally. It can miss earnings. It can beat earnings and rally, miss earnings and tank. It can beat earnings and tank, miss earnings and rally. I don't give a shit. Earnings is not going to be your bread and butter of how you trade. How are we not moving? People came hot as NFP. We have war and everything is bad. Yep. We definitely need a minimum 70 IQ to participate in the stock market. Not average, minimum. Anonymous, appreciate your donation. Thank you. Do you still consider RKLB? You know what? RKLB setup was yesterday is when I sent it out in the chat. This right here is not my favorite setup. You could still take it because I think it's low risk. Since they did an offering yesterday, you can take it with a tight stop. Not my favorite setup because if you remember the trade that we had on Qubits, when Qubits had that 20% day on December 22nd, you had a very similar thing where it broke out, but then it never recovered or followed through. It was just a one-day fluke. Could be the case here. You could still take it. You know, we got rejected at the 50-day moving average. There are much better stocks that have already tested the 200-day. And to me, this looks like it could now be manipulation. Like I wanted to be part of the initial push. I don't think that this is an A+ setup. Certainly you could take it, and certainly it could work out. But, you know, I think that the strength of the move down is not what you want to see out of a retest. Plus, the volume so far on this move down is almost just as much as the volume on the move up. On these break and retest setups, you want to see the volume much lower on the moves down. That's just my opinion. B Nuge, appreciate your donation. I banked after you showed RKLB. Hell yeah. When is AlphaScope going to be released? Good question. April. Why is it that you do not take trades based on indicators for scalping? No idea what you mean. Market is dropping. I bet that is manipulation. Yes, dude. Look. All of the gamma is situated below. So we likely at least take out 65.50 on SPX, if not 66.15. Sorry, 66.50, if not 66.15. And you could see some of the liquidity building higher at 6,700. Do you shower? Yes, with your mother. She actually bathes me. I pay her to bathe me. She normally offers to do it for free, but I feel so bad. Because I'm like, look, you at least got to get Mark Thomas a meal. You have to get him a meal on your way home. I feel bad. I know you want to do it for free. Let me at least give you $10 so you can buy little Mark Thomas a meal from Arby's on your way home. She told me you loved the roast beef sandwich. So I give her $10 every time. So we going down some more. Again, required minimum IQ of 70 to join the stock market. Yes, dude, it's possible we go down some more. What does that mean in context? First time hearing you live. I either apologize or I'm glad that you're joining now. Either way, welcome.
As we count down to the Fed Chair Powell's press conference, starting in just a couple of minutes' time, we have David Kelly here on set with us from JP Morgan, Tim Urbanowitz of Innovator Capital, and we have a market guys near session lows. Don't want to make too much of it, David, but sometimes the first move is the tell, sometimes it's not. A lot of people are bracing for more hawkish commentary from the Fed chair. Do you think we're going to get that?
I think probably we will. In the sense that I think he's going to say, look, the economy really looks pretty good. All the indicators, no matter how low confidence is, the actual indicators of the movement of the economy looks pretty good. But I'll be really interested to see what he says about the tariff outlook, because they have to have some assumption here. And I think as you go from IEEPA tariffs, which were high, to now some sort of replacement tariffs, it's not even clear how much they're being implemented, to something else.
What I want to see from price action, all jokes aside, I want to see at least one of the indices take out its low of the day, while the other one doesn't. So, like, for instance, if ES takes out that low and NQ doesn't, then that will signal to me that we see a little bit of a long while Powell is talking. The way that it looks to me right now, actually, shit. I just realized fucking ES took out London low. Bro, and NQ didn't. This might set up the long on NQ. Now, if we do get a long, my take profit will be before the high of the day, right? It'll be like in between the 0.5, maybe this high, and the golden pocket, where this 15-minute is right here. Because if you look at the gamma as well, I don't base everything off gamma, but I like to know what's realistic. $6,700 is where we have some gamma buildup here, which is the gap on SPX for the day. Now we do have some gamma at 6650. We could see a move like this before a move higher, or a move higher before a move like this. We're going to manipulate both ways. So before someone says, are we going down? Are we going up? It's going to do both, okay? If you can't handle that, go buy Treasury. NQ, there's a sneaky long here.
Here we go. This is Fed Chair Jerome Powell taking the podium.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5 to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal.
I'm looking for a potential turtle soup here.
Well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Thank you. Colby Smith of the New York Times. There's been some debate about whether the Fed should look through the inflation that will come from higher oil prices stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods and on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil. But it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
I still think there's a turtle soup possibility here. Was up almost like 1,000 per contract. I ended up putting my stop to break even, but I do think that there is a possibility here for a turtle soup. When did this fool start talking? So 2:30. I should be scalping this, to be honest. But I think this can work here. Let's just see if we get follow through. Also, did ES take 230 high? Would love to see it taken to these equal highs up here. But we keep getting a turtle soup reaction. Without follow through. Which is good because when you get a turtle soup reaction like that, it allows you to put your stop limit to break even immediately. But you see all these equal highs here. Would love that target. If we caught the absolute fucking bottom here. Let's see. Obviously, you can keep scalping this. Like I keep giving you guys $500 to $1,000 per contract on these scalps. But if we get a closure above this, I might even add to this. Let me see what ES is doing real quick. I think this might play. That right there is 230 high. And the reason that this is significant is because this is when Jerome started talking. But I want to get to these equal highs.
We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, you know, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period, meaningfully higher. So I wouldn't say there's much of that happening. Not much will be happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that having looked through tariff inflation and inflation running above target and looking through the oil price shock would undermine the credibility of your commitment to the 2% target?
You know, we have to do our analysis and think these things through carefully. But of course, that's on everyone's mind. You know, we're well aware of the history, but you don't want to overreact to that. You know, you want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations. And so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And, I think it's important that we do that. Very important.
Nick.
Nick Timmeros, Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well, as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not.
So I should be honestly scalping this because left some good money on the table with all these break evens, but I do want a bigger move. And we do now have gamma building up at 6,700 once again, and there is some gamma below. So I would much rather see a move down and then a move up. We do have these equal lows now on NQ. We did have bullish divergence. We don't have it anymore. You can make the case that there is slight bullish divergence here. And I want to keep my eye on this because I do think that if you look at the high time frame, we took out London low on ES, NQ didn't. So I do think there is a long to at least that 230 high. And I'm going to keep trying to get that with a very small risk. And I think it gets there. So that 230 high, that's data high. That's data high. I do think we get there. It's just a matter of from where. Do we take out these equal lows first? Do we jump off from here? But make no mistake about it, on the high time frame, we now have, or not high time frame, on the time frame that shows London low, we do have bullish divergence. So I might wait for NQ to take out these equal lows.
Confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you will all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet. And I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent would you think we're in a different place today? Thank you.
You know, it's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS report that was mentioned briefly there. It doesn't seem from the projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently and that the February jobs report was cause for concern?
So I think you have to take the two together. You know, in a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather, and that's about 80,000 of the negative effect total on the February report. Notwithstanding that, so what do you see if you take a step back overall? There are a number of indicators that suggest a degree of stability, but the thing that I think good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent really, growth in the labor force, which of course we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now that's balance, okay, but I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless something we watch carefully.
Andrew.
Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years: COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common? And does the central bank need to start taking it?
So I want to see if NQ takes out that low, or because we did hit that 6650 gamma on ES. I think that low right there is the draw on NQ. ES had already taken that low. That's London low, by the way. And ES took Monday's low just now into that 2-hour fair value gap. Sorry, that's Monday's pre-market low. Yeah, I mean, Jerome Powell isn't saying anything novel, to be honest. You know, as a matter of fact, he does sound even more dovish than people thought coming in. So I think NQ tags 24/7/28/25 first.
Ways that oil-related commodities go into manufacturing and that kind of thing. The truth is it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens. And it'll come down to how long, the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa. Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most members are penciling in a slowdown in growth.
No.
But has there been any discussion of the risks of stagflation at this point?
So people actually wrote up their growth forecast by 1/10, and I think that's probably to do with just growing confidence in productivity. But sorry, and your second question was just.
If there have been any discussions about the risk of stagflation scenario.
Yeah, so as I mentioned, there's tension between the two goals, right? The upward risk for inflation and downward risk for employment. So, and that puts us in a different situation. When we use the term stagflation, I always have to point out that was a 1970s term at a time when unemployment was in double figures and inflation was really high and the misery index was super high. Add them together, you get the misery index. And that's not the case right now. We actually have unemployment really close to longer run normal, and we have inflation that's 1 percentage point above that. So calling that stagflation, it's not. I would reserve the term stagflation for a much more serious set of circumstances. That is not the situation we're in. What we have is some tension between the goals, and we're trying to manage our way through it. It's a very difficult situation, but it's nothing like what they faced in the 1970s, and I reserve stagflation for that, the word for.
I think there's a chance of a long here because we still have divergence with ES taking out London low and NQ not. And it looks like we had an extreme gamma buildup now at 66.35. I think there's a long to the 230 high. It's going to be a quick one. And that would be the extent of it. We do now have a CISD here. Remember, that 230 high is Jerome Powell's high. Let's see what happens here. I told myself I should be scalping twice. Again, I want a bigger move. I just want a big move to 230. That's it.
Will be a one-time effect. I don't think we've seen you since the Supreme Court tariff decision, and it's pretty clear that none of us know what the extent of the tariff shock will be as the administration moves to replace some of the tariffs that were overturned. So I suppose I'm curious, what would make you question this certainty that tariffs are going to be a one-time price effect?
Well, I would not at all use the word certain about my views on that. I'm not certain. I'm uncertain. But just if you think about what it is, it's a one-time increase in the price of a good, right? And what inflation is ongoing increases in prices this year, next year, the year after. That's what inflation is. It's not a one-time price increase. There's a very, very big difference. The public doesn't really focus on that, but that's the difference. And tariffs should be in theory, unless they cause people to start.
There is a chance we reject off this 5-minute fair value gap and then take out London low. But I'm hoping that divergence where ES took out London and NQ didn't. I hope that holds. I'm still not willing to really do anything without my stop limit going to break even. Again, I could have just scalped this and would have been up an additional $2,000 for the day, but I really like to play for bigger moves.
So, and we assume that they'll do that over time. So that's how we think about it.
Thank you.
Hi, thank you. Chris Rugaber at Associated Press. You talked about the shortcomings of the SCP in this environment. I wanted to ask about, or throw in an additional thing, which is the fact that it's happening before transition. Is there still some value, perhaps, in the public knowing what other Fed officials are thinking, the ones who will stay on for the rest of the year and beyond? And does that even handicap your successor in any way? Well, just in terms of having a whole committee expressing its views, is that something that locks them in for the rest of the year?
No. We never. The SEP is never. People are more than happy to change their SEP dots. They're no way bound by them. It's your opinion at a moment in time, which can change based on events. Sometimes very quickly. So it never locks people in. People are more than happy to be proven wrong in either direction. And so I just think we do it. And, I mentioned this was a time when it's very hard to do it. During the pandemic, we actually took one meeting off, I think. But we don't like to do that just because it's hard to do. We should just keep doing it. But I just would say for this one, though, I think it's even more than usual good to take the forecast with a grain of salt, because subject to just very high levels of uncertainty.
Brian. Hi, Chair Powell. Brian Chung with NBC News. So you mentioned at the beginning of this conversation that you're well aware of the history of inflation running above target. It seems like that might be what's underpinning the affordability problem that we're hearing a lot about on Main Street. Are there any signs to you that that's impacting the psychology of the consumer, especially given that they're a big driver of overall economic activity?
I'm not sure what.
I'm going to wait until this 66.35 is hit on SPX. Down here. Especially because this gamma just increased. Honestly, kind of a lackluster FOMC. I think a lot of it was priced in for sure. Why not short it to there? Because I don't like shorting at a discount. I mean, unless you're scalping, yeah, certainly. You could take a short from here. For a nice little one-to-one scalp. Just not my favorite trade here. I think there's a short on crude oil overnight.
AI, we won't know for years what it's really due to, but it could be due to the kind of things that people did during the pandemic to economize and somehow become more productive because there was an incredible labor shortage. But I think economic forecasters are very skeptical of periods of high productivity because they're so rare and they're often revised away. And for many of us, I never thought I'd see this many years of really high productivity, and by the way, expect it to continue. And we haven't really started to see the effects of generative AI, and that should certainly contribute to that. So it's quite unusual, and this is the higher productivity is the thing that allows incomes to rise over time, and so it's a great thing. Was that your question?
Yeah, no, I was just curious what lay behind that, and just briefly on that as well to finish up. You hear the argument a lot, this is a sort of disinflationary story, and if you believe that productivity thing, that should also weigh down inflation over time, maybe then kind of pull down where rates end up. Do you kind of agree with that line of thinking, or do you think that's not how you should think about where the rates
I think you have to be cautious about that, in particular if you're talking about AI, about generative AI. So remember, in the short term, what's happening is we're building data centers everywhere, and that's actually putting pressure on all kinds of goods and services that go into building these things. So that's actually probably pushing inflation up at the margin. In addition, it probably raises the neutral rate. So in the near term, you're not looking at something that would immediately call for lower rates or that would be lowering inflation. Over time, though, sure, it can be if it's expanding potential output, which is what higher productivity does, then it actually can be. But I think it's an empirical question because it's really is the demand growing faster or slower than the supply side? And I think we just don't know that answer ex ante going in. We'll just have to wait and see. Thank you very much.
Welcome to Closing Bell. That was Fed Chair Jerome Powell. No rate cut as expected. Stocks didn't initially react to that news, but look at the charts if you can. During Powell's remarks, the Dow dropped about 200 points from down 400 plus to down 600 plus where we are now. All the major averages down at least 1% and near their...
All right. We didn't get, honestly, that big of a move on FOMC. There's 40 minutes left until the market closes, and we haven't taken the 230 high yet. I hope we don't just stay pinned here, according to Gamma. 66.35 is what SPX is projected to take right down here, which means that NQ will likely take London low. There it is. The good news is that Jerome Powell said he doesn't see stagflation as a threat. He said it's a lot more serious. Like stagflation happens in a lot more serious circumstances. And that's not something that we're likely to deal with. I'm talking about yesterday's London low, dog. Right there. Moro. Right there. Yesterday's London low. The fuck? What are you smoking? Smoking your mom's cigarettes. Now that we took yesterday's London low, which evidently is yesterday's low, wonder if we have enough time for this to turtle soup to the upside. $66.35 almost taken. Damn, I should have just turned into a scalper today. We need a call long or short. Gives a sign. Moron. $66.36. Yeah, I think we get a short in crude oil from here. I might take this overnight from that 97.50 range. All right, we hit that 68.35. I think we get a long to 66.50. I mean, that's just right here, honestly. Man, I would have made way more money fucking scalping today. Meh. Where do I see the indices? I mean, you watch my videos. I think we're going to a correction. I said that in January. And in my last video, what did I tell you? I said, look out for this gap. When we move into this gap, that's when you want to short. Right now, I think it's safe to say that we are going to hit the 200-day on both SPY and QQQ. And, you know, we rejected off that 200-day, or sorry, we rejected off that gap, likely to go down to the 200-day on at least one of them. So that's where I think we're going. The thing that makes this shit is that, you know, the VIX is still pretty high. And it's hard to buy puts when the VIX is high, right? Your best chance was yesterday. And so you need to pray for another up day in order to get a better price on puts. But I do think that we're going to the 200-day, and I think that eventually we go down to this weekly gap on both SPY and QQQ. Down here. Is Powell done? No, dude, he's still talking. You see him on the screen? This black dude right here, that's Jerome Powell. Oh, damn, bro. This is so boring. We're just being pinned right here. You watching the Champions League? No, dude. I no longer watch sports like that. It's a waste of time. Yes, I just came back from snowboarding. We're not even going to get a fucking mock today, are we? Man, all right. Yeah, pretty sad FOMC, to be honest. There's blood on the floor tomorrow? No, dude, that's today. Tomorrow is more likely to not be blood on the floor. All right, guys. Fed didn't raise rates. Obviously, Powell said that obviously oil poses a threat to inflation. He doesn't see the tariffs as that risky, and he doesn't see stagflation. Didn't really get the moves that I'd hoped for today. Had some really nice scalps that I ended up just holding until break even. Hindsight, would have made a lot more money on those scalps. If I did turn them into scalps. This morning I had a really nice trade, so still up like 3K on the day. But was hoping more from FOMC here. Let's see if we get a mock trade here. What do you think of Tom Lee? Seems like a nice guy, but he's a clown. That whole crew, him and Dan Ives, Ryan Dietrich, they're just permables. Now, if I had to pick, being a permable is much better than being a perma bear. Because statistically, you'll be more right. When was that day that we had a big green day? $66.45? No, dude. Oh, wait. 66.45? I lost your message. Can we close above 66.45 on SPX? This is some dude who's trying to play 0 DTEs. A lot of times people ask questions and they think that they're being stealthy, like as if I won't know what the fuck they're trying to do. It's like, what are the chances that we close above 66.45 today? What do you think that dude's doing? Fundamental analysis? No, that dude's gambling. Dun 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 dun. What are the chances I drive past McDonald's today and just hit the casino? Sell CFD, gold, silver? I don't fucking know, bro. I don't trade that junk. Who in God's name trades CFDs? Drink coffee, mate. Okay. When your mom gets here, she's going to make it for me. Don't trip. What are the chances I like, share, and subscribe if you stop being so depressed? I'm not depressed, dude. Just because I'm not amused doesn't mean that I'm depressed. Plus, I'm concentrating. Plus, I don't give a fuck if you like, share, and subscribe. If someone wants to like, share, and subscribe, then I appreciate them. If someone's like, if you don't do this, I won't like, share, and subscribe, then don't. This dude's attitude's whack. Your mom loves my attitude, bro. She said I'm the funnest person she's ever been around. And all I did was take her to the movies and buy her some Milk Duds. That's all I had to do. And she said, you are literally the funnest person I've ever been with. She's never had Milk Duds before. I think there's a nice opportunity on Uber here. And no, I'm not taking that short on CL. Not yet. I'm going to monitor it in the Asia session. I do think there's a chance it could take out a high first. Let's be a bit professional, man. Shut the fuck up, bro. Who are you, my boss? I do think there's a good opportunity on Uber here. It gapped up yesterday, now retracing. I think by tomorrow, this may present a long opportunity for sure. I thought Google was a decent long before. I ended up closing this yesterday. I wonder why the VIX is up 9% even after the meeting. No, but we're not kids. Yes, exactly. This is not a kids channel. So, what are you caring about? I think there's a sleeper short on the Dow Jones and transportation average too. I think this. Let me see. What do the options liquidity look like on this? What is the ETF for this? I guess there isn't an ETF, but there's a leveraged ETF. I bet you the options suck on this. Bro, this knowledge 021 guys, a real Karen. Who knew those were still around? God, I need to find a better way to do this. I mean, this to me is just a clear sell model. And the reason that I started looking at the transportation average is, as I was telling you guys, the Dow Jones and the Dow Jones transportation average are going to give us a hint of which direction the markets want to go. And the Dow Jones tends to top before other markets. It did so in 2022, 2020, 2008, 2001. The Dow Jones topped before the other ones. I just need to find a better way. Oh, I think I found it. Hold on. There it is. IYT. The liquidity on this shit is ass. What does the bid ask? Oh my God, this is atrocious. What is this? God damn it. I really like that pattern. I bought cheap Dow leaps. When? And how are they up? What do you mean you bought cheap Dow leaps? The Dow is down. Thoughts on gold. Thoughts and prayers. Yeah, where I think the Dow's going, by the way, I think it goes all the way down to here, at least. Now, what's ironic about this level, this is November 2024 level, right? And that means that this is going to give up the entire gains from Donald Trump's election. If it goes back to November 2024, that means it gives up all the gains since this second presidency, because that was the election. And I think it goes back down. I think the Dow goes back down to that level. I didn't realize it was market over. All right, guys. Pretty lackluster. In terms of FOMC, didn't get any trades in, which is unusual. Or I didn't see any trades through. Had a couple of trades that were moved back down to break even. Better than losing money. But yeah, not what I expected. I think SPY and QQQ are going to the 200-day moving average. That's pretty clear. SPY might get there tomorrow. OPEX is on Friday. And then I hope we get an update, because I do think the market is still a short. I hope we get an update, because I do think the market is still a short. The only thing that saves the market from a correction is if Donald Trump pulls back on the Iran stuff. That's it, in my opinion. That's the only thing that saves this market from a correction. Otherwise, I think it goes into a correction. This guy says, the face don't look good at all. Also get a haircut. Let's look at this guy. All right. This motherfucker right here with a receding hairline, glare in his glasses, looks like he's staring at the sun, and a fucking triple chin. How can you still have a triple chin with stubble on? You can't even hide the fucking triple chin, bro. What is this video that he's got?
Dale.
Oh, this is a picture of his mom, or a video of his mom. I mean, you know, most moms can get it. Not that mom. That mom can't get it. Michelle. Just because you have a receding hairline Doesn't mean that I should cut my hair because you can't grow yours. Buy some glare-free glasses and tell your motherfucking mother to get off the internet, okay? You have a video. The only video you have on the internet is your mom dancing. What is that, bro? Have some dignity. And get rid of the triple chin. That's not a good look for a man, bro. Stop eating fucking fries and beans. Get your ass in the gym. Hopefully your life turns around right now. Hopefully you get so mad at me that you fucking hit the gym, get contacts instead of those fucking cheap ass glasses with glare. You couldn't even tell your doctor to get you the glare-free lenses. That's how cheap you are. Looks like you're staring at Venus, bro. Get rid of the triple chin and take your mom off the internet, all right? Most moms can get it, not your mom. Fucking loser. All right. We'll see what's in store tomorrow. Hopefully, it was a good trading day in the morning, but I felt like I wasted my time in FOMC. Hopefully, tomorrow morning is a better day. Or hopefully tomorrow's a better day. I think it will be. I think once we get a move up, if we get a move up, I hope the market just doesn't tank like this. If you look back to, this is the last thing I'll say, but if you look back to last March around this time, we got a nice move up before we were able to take this down. If you look at 2022 in March, we got a very nice move up before we were able to take this down. So I hope that's the case here, even in 2023. We got a nice move up in March before a pullback. So I really hope that we get a nice move up, because this like slow grind, your puts are getting killed. We made money on puts like one day. And yesterday you would have made, if you bought puts yesterday, you would have made money today. But this slow grind here, you're not making money on puts. You need a nice up day to take it down. No, I'm not shorting this on crude oil. I think this high gets taken in Asia, but I will be monitoring it. All right, guys. I'll see y'all. For those of you in the Discord, I'll see y'all tomorrow. The rest of you, I'll see y'all when I see y'all. Peace.